the 1st of September 2024, and this week's was called Back to School. So for those who have tuned in before, you'll know I like to start with a quote, and this week's quote was, "Education is the most powerful weapon which you can use to change the world," and that was from Nelson Mandela, the former president of South Africa, and a quote that I very much identify with and agree with. So before we get started, I just want to give one more plug for the tickets for the next property business workshop in London, Tuesday the 1st of October. And this time around, Rod Turner and myself are covering exits. We've got two main objectives for the day. First of all is about planning your own, which people do very poorly in our experience. And secondly, so you can understand other people's exit plans, perhaps challenge them, perhaps help build them, and assist really when you're looking to buy a portfolio or a business, because so often their lack of exit can get in the way of them doing the deal. So not only can you help the vendor get what they want, need and deserve, you can really work through a true win-win situation where you can both benefit. And as always, it's going to be an action-packed and content-filled day, which will stand alone in helping to advance your understanding as a property business owner. The link is live. There are early bird tickets still available for a couple more weeks. And that's bit.ly/PBWFOUR. Thanks very much and welcome to the supplement proper. We're into the last third of the year now, the third quadrimester, if you prefer. And there's lots to discuss this week, as always. In the deep dive, I'm going to get into a Hamptons report that has been lost in the least quiet summer I've ever had regarding BTL purchases falling to a record low, and a look at some 20CI analysis, which does a great job at putting some of the data into a proper contextual format. The gear change is slow, to say the least, and in the last few days we learned that housing starts were down 34% to under 30,000 in the first quarter of this year, with completions in the year to March at 183,610. That 370,000 that Angela Rayner has set must feel like a long way away, but they are indeed starting from a pretty low base. We're going to have a squiz at the ONS report too about housing starts and completions and get into that in a bit more detail. But before any of that, I'm going to press on with the real-time market analysis. I always give kudos to Chris Watkin, who delivers week in, week out on these. I spoke to Chris on Friday night about a technical point. You'll be glad to know that's what I was thinking about with my Friday evening, which was a good, fun conversation, as it always is. He also offers some bonus content too sometimes. And the figures for this week show plenty of listings, still 35,000 across the UK as we gear up for what's usually a busy period, although August has been a bit busier than usual thanks to that interest rate cut. We're still seeing about 7.5% more listings than we were on an average week before the pandemic. Net sales also outperformed, 34% higher than the equivalent week in 2023 and nearly 15% higher than the pre-pandemic market for the same week. So that's how much busier that week of August has been, and you'd have to put that down to the first cut of the interest rate in this cycle being responsible for that, I think anyway. The average listing price was up a couple of percent on last week. I think the market smells blood and knows that September has come, but still new listings were around £407,500 on average, which compares favourably to the average 2024 listing price of nearly £440,000. The market still looks reasonable value, and I'm seeing some retail transactions happen and thinking that's a bit of a bargain really, which I very, very rarely do. I'd say it's a good time to be moving residential property if you're going up the ladder. That's my personal opinion. So before I get into the macro, I just wanted to note the screaming that for October the 30th that is now going on. You can't move for people wanting to exit within the under 2 month timescale after the Grim Reaper, Mr. Starmer, spoke this week in a wrist-cutting soliloquy. All I keep seeing is a mistake about manifesto tax promises getting compounded time and time again. The new rhetoric has shifted to allow taxes on employers to go up now. I think employers' national insurance is in danger, and hospitality and retail will be creaking if that's what goes on. Inheritance tax, capital gains tax, pensions relief, they must be going up or down in the case of pension relief. This really is a bit of a meatloaf moment where 2 out of 3 ain't bad, if that's what the public gets away with. But listen, don't get mad, get even. Capital gains tax, just refuse to sell anything. Inheritance tax, just don't die. Okay, I accept that one's harder. Or marriage someone an awful lot younger, because remember, there's an interspousal allowance. Of course, my tongue is firmly in my cheek when I give those recommendations. Look, you've got to get yourself in shape to perform rapidly and give vendors what they want and they need. We don't have any mottos in my office on the walls, but if there was one, I reflected this week, it would say, never discourage a keen vendor. As always, the fear will be worse than the event itself, but as I write this, a poll I'm running on my LinkedIn has Leave the UK as the most popular option to cope with the tax rises that are coming. I'm sticking with keep calm and carry on, don't worry. So, onto the macro. We had the Distributive Trades Index, the Nationwide House Price Index, the Bank of England Money and Credit Report, including the money supply, and you know that we'll round up with the gilt and swap yields. Distributive trades. A brief reminder, these are produced by the CBI, the Confederation of British Industry, and it's a survey around retail sales volumes. It was another negative print, -27, which was an improvement on the horrific July number of -43, but still well below consensus expectations. Selling price inflation looks to remain below the long-term average next month, and it's already there, which is one bit of welcome news. Sales were poor for August, and retailers expect to further reduce investment over the next 12 months, as if they could invest any less. Retail employment is contracting for the majority of survey respondents, as it has done for 8 quarters in a row, or 2 years in a row. The principal economist for the CBI, Martin Sartorius, put out a hopeful quote. The sector will want to see measures in the budget this autumn to give certainty to firms and incentivise investment. Reforming business rates, including a business tax roadmap and changing the apprenticeship levy, would help businesses to deliver on the government's ambitions to supercharge the economy. Yeah, I think he probably knows that he's doing his job there, and fair play to him. It's worth a go, but realistically, something's going on towards the wind that's not gonna work out. What will come good from the Iron Chancellor's scythe of a budget? I'll stop calling that soon, probably. Or we'll have 2 months of that. I'm not going to apologise anyway. But let's consider everyone's expectations to have been managed. So, volumes in every retail sector have contracted and are contracting. And thanks for the comment, Shyam. I've seen that. I'll respond to that at the end, if that's okay. Volumes in every retail sector have contracted and are contracting. The business to consumer, or the consumer market, is a very tough one right now, however you look at it, especially if you're selling goods. Not so much services, but goods are problematic. There's room for improvement in the future, you'd think. Nationwide next, and how I enjoy their numbers. After finally coming round to the market, 6 months plus after supplement listeners last month, they then saw a 0.2% contraction in August. You might think this is standard for August, but these are seasonally adjusted figures. They led instead with a headline about annual house price growth, as that did improve to 2.4 from 2.1. We won't remind them that back in December they were forecasting another small decline in low single digits or remain broadly flat for the 2024 property market, although I just did remind them of that, of course. They still see prices about 3% below the summer 2022 prices, according to their numbers. There's some interesting data deeper in their report this month, though. They take a look at price premia for energy efficient stock, or reframed, significant price punishment for energy leaky stock. So, A or B rated properties now tend to trade at a 2.8% premium compared to a D rated property, which is still the average in the UK. Around C to E, there's very little difference, and Fs and Gs, which of course you're not allowed to use as rentals, although there's plenty of people that still isn't stopping from what I see on a week to week basis, are trading at a 4.2% discount to a D. So it's a 7% difference there between A's and B's and F's and G's. Now, these numbers have moved a bit since 2019. In those days, the premium was 1.7, not 2.8, and the penalty was 3.5, not 4.2. So the market is slowly waking up, moved from about a 5% differential to a 7% differential. We'd really want to know how much of this happened after the utility pricing changes in the winter of 2022 to really see if that started to shift attitudes and willingness to pay for less leaky properties. Now, if you think like me, you might hear those stats and think, hang on a second, A's and B's tend to be newer build. But Nationwide have thought of that and controlled for it, we are told. We have to take that at face value because this isn't a research paper, this is just a press release at the end of the day. 48% of housing stock is now rated C or higher, which is up from 18% in 2012. Now that should be lauded as an incredible achievement, to be honest. New builds do increase that by about 1% per year alone, if that, maximum. So it isn't just 12 years of new builds making that difference. The average cost to get to a C was £7,400 apparently, with E to G costing £13,500 on average, whereas D to C costing about £6,200. And remember, those are the costs looking backward, not the costs looking forward as we approach 2030. I thought this was interesting and timely, and they've clearly done this to coincide with the reintroduction of the notion of EPC targets for the PRS by 2030. A landlord survey this week revealed that 95% of landlords think this is impossible. And indeed, it will be. Although the rules will be fudged, of course. There are already fudges, listed buildings being one. There will need to be a provision for leasehold, even with reform bills, unless legislators are idiots. There's really quite a limited amount of measures you can take within a flat, certainly in some flats with certain types of freeholders. Now, a monthly favourite of mine, the Bank of England Money and Credit Report. These are July's figures. They're always produced a month in arrears. Most look at the number of mortgages completed, and that's a good gauge of the health of the market. But there's plenty more richness in the data if we dig a little deeper. 62,000 mortgage approvals is the highest print since September 2022, where it was over the magic 65k, which I've always said for the last year or so I've been commentating on these numbers, I'd like to see as the sign of a really healthy market. Remortgages fell back to 25,100, which is fairly low. More typical lately, we've seen the number around 30k. Private companies paid back 3.6 billion of finance net for the month of July, although 2.3 billion was net equity buybacks, which personally I wouldn't necessarily be counting with too much vigour, but of course it is technically finance. It's just not traditional debt finance. The money supply also moved up a little, although the expectations were higher. We're still lower than October 22, when quantitative tightening really started. Some other stuff happened too. I don't talk about it much, but you might remember very thin Lizzie and her rain or shower. It was below consensus, but still up 0.3% month on month. And you know, I always say money tends to find a home, as the monetarists say. Not really looking consistent with 2% inflation quite yet on that front. And as we get deeper into the mortgage stats, we saw an average drawdown rate of 4.81% in July, which wasn't much different from June, but as at today looks expensive, with sort of 3.6 being the best price on the resi market. I'd expect it to be more like a low 4. The average outstanding debt in the stock is now averaging 3.69%, creeping closer to that 4.81, which I think now is going to crater within a couple of months. Credit card borrowing is still growing 10% year on year, but it's still not overly worrying yet, as the sector is still repairing from massive net paybacks during the pandemic. So, a healthy buying month in July 2024 by the looks of it, and many were perhaps waiting to remortgage when they felt the Bank of England might cut rates in August, as indeed they did. I'll be watching this report next month with continued interest. And then the gilts and swaps, our staple of the macro. The 5-year gilt closed Thursday at 3.795 and Friday at 3.816% yield. And the 5-year swap closed Thursday at 3.704. We opened the week at 3.777 on the 5-year, and so it was a tiny up week with little news of consequence based on a short week thanks to the bank holiday. I'd rather down than up, of course, but tiny up is acceptable, of course. 9 basis points of discount between the swap and the gilt looks back to roughly standard times for 2024, which is still leaving our best guess 5-year mortgage money rate for limited companies at about 5.7% or so, or the equivalent after fees are amortised. Great. Hopefully we can trend down on the swaps and gilts next week rather than creeping upwards. So on to the bigger soapbox for this week. And this week, the common theme is about Exodus. No, not the second book of the Bible. It's more than Exodus, actually, because it's also a lack of replacement that should be concerning those at policy-making level. I've often praised the quality of Hamptons research. They're so much more sensible and less dramatic and much more realistic than so many of their rivals I could name. They lead with the headline, buy-to-let purchases fall to record low. So you can see they're not really concentrating on the Exodus side, but the replacement side. They frame what you might expect quite nicely. Tax and regulatory changes since 2016 have been the main culprit. But these disincentives to invest have been compounded more recently by higher interest rates and political uncertainty around the threat of more rental reform. very good. Needs evidence, of course, which they're normally quite good at. Some of that evidence can only be provided by survey. And then how do you survey people who didn't do something with any accuracy? It's not easy, and I'm always suspicious of surveys about intention rather than action. But there are a number of ways that various portals and agencies measure landlord sales and purchases that we can get into. Hamptons are a large organisation, but they are heavier in the south and east, and that does need bearing in mind. They have produced from their own internal figures a graph running from 2010 showing sales versus purchases for landlords. The lines crossed rapidly after the 2015 budget, and this can be no coincidence. So before the 2015 budget, there were many more purchases for landlords than there were sales. Then they crossed over, and the lines have yet to meet again. So, if I give you a rough idea, 16% of homes sold by Hamptons were bought by private landlords in 2015. This dropped to 13% in 2016, and then 12, 11, had a brief resurgence in 2021 and 2022 as people speculated with their stimulus money, their bounce back loans, their COVID, their CBILS loans, and all the rest of it. And eye-wateringly cheap rates in those years, certainly the beginning half of 2022 as well. But now in 2021, H1, the first half, it's cratered to only 10% of all transactions. So that's the all-time low of since they've been keeping the figure since 2010. In the meantime, in 2010, private landlords represented only 4% of all sales. The buy-to-let sector was still really young back then, especially if we measure it by the introduction of the first buy-to-let mortgages in 1996. There are other reference points we could use, of course, but that's when the real explosion in rental started. This hit 16% in 2016 and stayed there, although it's dipped and risen a little since. At only 13% in the first half of 2024, many have obviously not sold, but although I used it as the graph for this week, which you can check out on my LinkedIn or on the Partners in Property website, the links are in the comments or in the show notes here. If you subtract the percentage of sales from the percentage of purchases, you've got a brilliant idea on the direction of travel in the sector. So 2010, the difference was 10%, then 7, 7, 5, 2, 1 in 2015, and then we went -3, -4, -5, -3, -2, -2, -4, and -3. So if I aggregate those together, and we're still at -3 in the first half of 2024, by 2015, 32% more transactions that Hamptons had performed had been purchases of buy-to-lets rather than sales. Since then, 29% have been sales rather than purchases. So nearly really moved back. Now, earlier on in that cycle, the volumes would have been maybe a little bit higher, not 2010, but then we had a hugely high transaction volume in 2021. So it's roughly evened out nearly, and we're looking at getting back to the same sort of volume of rentals as we might have had in a year like 2010, which would be nearly unthinkable. Although if you remember, the rental market had still exploded thanks to the financial crisis because a lot of people couldn't sell, but with the low interest rate they could hold on and they then chose to rent. But listen, the direction of travel is worryingly clear. The English Housing Survey, which you would expect to have superior data, would dispute the clarity of this pattern. However, as I say, when you consider it's likely London or South East heavy, this makes loads of sense. The period of meteoric growth and speculation came to an end in London in 2014, 15, 16, depending on which part we're talking about. And you'd expect investors to have therefore become net sellers, and even more so once the tax changes and the interest rates have kicked in. Hamptons also tell us that in their experience, the investors who have continued to actively buy buy-to-lets this year are mostly cash-rich, larger landlords who are continuing to expand their portfolios. If H2 of the year replicates H1, there would be 113,630 new purchases in Great Britain of buy-to-lets, 75,900 or 40% fewer than in 2015. Regional figures largely bear out my accusation of Hamptons being southeast heavy, but they confidently predict and share figures for all regions. But the real illumination on their regional figures is Scotland. Draconian rent controls have seen investors vote with their feet, with only 1 in 20 or 5% of transactions being for buy-to-let in Scotland. Plus that 6% ADS, as they call it in Scotland, the additional dwelling supplement, puts off even the most ardent for both ideological and practical reasons. There just isn't room in the transaction for the vendor and the purchaser to share that burden of 6%. And as said many, many times over, stamp duty, land tax is an incredibly inefficient tax, and it's done exactly what they wanted it to do ideologically, but it's not helping the tenant, folks. Scotland at 5% is lower than London at 8%. And London is the second lowest of all other regions in terms of transaction volume for buy-to-let. The West and East Midlands charge on, East Midlands at 13% and West Midlands at 15% of transactions, but that's still 5 and 6% respectively lower than their numbers in 2015. Now, I've got to provide some balance here. The 2015 market was overbought and overrepresented by buy-to-let landlords. There was a point around 2014-15 where £1 in every £3 lent for mortgages was being used for buy-to-let. Too much. Anybody with any common sense would be able to say that. But the correction has gone so far the other way, it's now seriously damaged and damaging the sector going forward. So 2015 is not our benchmark, but it is the point where the graphs start to cross, so you can understand why it's used in this analysis. But what you noticed at the time was that rents were progressing upwards very slowly. Less than wage increases, less than inflation. Would it be terribly presumptuous of us to suggest that those two phenomena were related, i.e. when there were plenty of buy-to-lets coming on the market rent was not moving upwards hardly at all, because ultimately there was a healthy level of competition, a healthy demand versus supply balance, which these days is just completely and utterly gone. So London's 8% is down from their 17% in 2015, and that's the largest drop on the books. Sunderland and Middlesbrough, specifically because they go down to city level, are seeing a huge influx of capital for buy-to-let at the moment, with 45% and 43% of transactions respectively being for buy-to-let. Yields and capital growth prospects look great, but rent growth on those sort of figures to me looks very unlikely. Derby comes in third at 32%, the mighty Barbados. Very, very popular rental market at the moment. Personally, I'd advise caution if you're looking at HMOs in Derby, because the market to me looks saturated, but that's a little aside for you. One of those things I see from day to day, week to week. Hamptons sees yields at 7.3% on buy-to-let, which is 1% better than 2015. Unfortunately, of course, the mortgage rates are 2% higher than they were in 2015, so all is not as good, plus limited company, higher mortgage rate tax, cost of delivery, etc., etc. 94% of portfolio still in personal name. What's changed since 2015? Section 24 tax and all the rest of it. But Hamptons also rightly point to the 3% stamp duty surcharge in 2016 for buying a second property or buying one within a limited company wrapper. They're saying that's cooling the market considerably, which makes perfect economic sense. Hamptons claim, if the trend for H1 continues, that 146,060 homes will be sold by landlords across Great Britain this year. The net effect on supply since 2016 would be a loss of 328,750 rental homes. Right, that's more rentals than there are void at the moment. So get your head around that. It's a seriously sobering number. And build to rent has filled some of this void, around 90,000 units at the last count. So you can still see net we've lost about 250,000 rental units. And there are more renters since 2016, which again is not a point made enough by other commentators, not fewer by some significant margin. There were 42% fewer rentals on the market in June 2024 compared to June 2016. 42% fewer. Nearly halved. Scotland is at 39 months in a row where annual rent inflation is up 5% or more, solely down to the Scottish Government's devolved policies. An absolute mess for tenants in Scotland. And look, I consider those to be truth bombs, which were also supplemented by this press release, which took a little bit of the other side of the argument, if you will, talking about the landlord supply side. And this was released this week. So 22% of newly listed homes in inner London are former rentals, according to TwentyCi. That's the highest in 10 years, up from 15.6% 1 year ago. TwentyCi's recent collaboration with Cornerstone Tax on the issue was quoted as claiming there's an exodus of landlords from the capital and the southeast, looking towards the northeast of England instead. A safer investment than the capital, with highest growth in property prices in the last 12 months. Those are their words, not mine. TwentyCi also added to this debate with the bombshell that in June 2024, 18.4% of all properties listed for sale had also been listed for rent within the 3 years prior to the sale listing. This is a fairly common measuring stick that the portals and the data aggregators use. Sometimes they use the past 5 years rather than the past 3. I think Zoopla used the past 4 or 5 years. But either way, this in numbers was 28,000 properties and 100.6% higher than in June 2023. And also 34.6% higher than in June 2019. Month on month, it was a 27.4% increase. Whichever way you slice this lemon, a lot more ex-rentals are being sold off. And this is not even seeing yet the massive impact that this cliff edge of a 30th of October absolutely terrible budget coming. People with some assets in the middle class are genuinely living in fear at the moment. And there's going to be a massive sell-off of rental stock in the next 2 months. The government just do not understand what they're doing with their rhetoric and their overall attitude. They need to have more clarity in their communication. So, election speculation, maybe that was in June, thinking Labour might get in or whatever, but I think we're going to see it go into overdrive now. It's now turned into a capital gains tax speculation frenzy, right? That's the word used by the Financial Times of all the papers. The only one you'd really respect for using that word, frenzy. This is serious on supply and is going to lead to a mad 2025 and beyond for tenants. This will take years and years to repair and favourable market conditions, and it's highly likely Labour have other plans, even if they don't today, although we've got the renters' rights bill to come, of course. But this is just going to, you can see the future. This is going to politically accelerate and accelerate and accelerate and become a bigger and bigger issue. And some people at some point are going to reach for some kind of idiotic solutions, which are going to make it even worse unless the government start listening to the private rented sector and to people who know what they're talking about. So, read and consider, bearing in mind one more time that the rental demographic is most likely quite a bit higher than before, simply because the population is higher than ever before, and that increased population number has primarily come out because of net migration, which normally, when you migrate into the UK, might be slightly different if you've come from Hong Kong, but generally speaking, 90+% of those people will try to rent property. So, available properties to rent are at their lowest since TwentyCi has begun recording the data in 15 years. 276,000 in July 2024 for the entire UK. If you want a comparison to before the pandemic, same month, July 2019, there were 369,000 available. So in those 5 years, we've lost what? About 100,000 units, just short, 93,000 units down. It's a huge percentage stock to lose. And what I've noticed at the coalface is quite incredible. I have never seen rental properties on the market at the extremely high standard they are today. Just in your comment there, Lee, I'll respond to that at the end as well, if that's okay. Thanks for sharing that with us, though. There are a variety of areas. We're constantly assessing rental comparables, potential purchases and the likes. And now I'm seeing places where, I'm talking 5 years ago, a 3-bed semi would have been 500 quid. So bits of South Yorkshire, maybe places like that. There's now nothing on the market within 3 miles. And I'm talking population dense areas, suburbs, I'm not talking the middle of nowhere. In the old days, you'd have gone on and searched for comparables within a quarter mile and you'd have been fine. Now you've got to go 3 miles, 12 times the radius in order to get comps. And you still wouldn't have the same number of comps you'd have had years ago at a quarter mile. And now what's on there is phenomenal quality, but it's £1,000 a month and upwards. The market rent for that 3-bed that you might be renting is now very difficult to determine. But you'd think a kind landlord with a mortgage still needs to be getting that up to about 750 in order to even just try and stay where they were 5 years ago. And a ruthless profit maximizer is going to be saying 900 quid, aren't they? So the numbers and the averages always hide all of this. Precisely zero of that available stock is affordable, useful or pragmatic for a family on the median wage. You'd need 36k from an affordability perspective to afford 12 grand rent outside London or South East on the traditional metrics. And that's roughly the UK median wage right now, but not in the area I'm talking about, which is South Yorkshire, as I said. So that leaves us with, that's a pretty comprehensive, I usually try and take both sides of an argument, but this is just so irresistible. The figures are where they are, and I feel I'm appropriately moved by them. But that leaves us with the ONS house building data, which I suppose the government, in a way, technically quite enjoyed on Thursday, because one of the last things they can blame on the previous administration. They've got about a quarter of that left yet because figures lag. This was only quarter one's house building data release. So UK housing starts, it was the third quarter in a row under 30,000 starts. So in the past 9 months, we've only started 82,690 builds across private sector, housing association and local authority. April to June 23 was anomalously high because there were these building regs changes in June 23. But nonetheless, when it drops off like that, we're likely to be left at a number because that's going to drop out the figures next quarter. And we're going to have, 100, 110, 100,000 housing starts for the past 12 months? We'll know in 3 months' time. And if that number's right, it'll be the worst year for housing starts since 2009, to put it into context. Completions, though, perhaps better. These terrible figures on the start will need to work their way through, of course. But the past 12 months, 183,600. 200,000 more on top will be what's needed to hit the 170,000 target in 5 years upcoming, which most industry professionals accept is just not achievable, and more like 275, 280, maybe 300 could be done, but I haven't seen anyone with credibility suggest we could do over 300 in a year. Not the way we're currently set up anyway. But to put this into context, between 2009 and 2016, we averaged 150,000 completions per year. So there was a bit of repair after that, which then collapsed around the pandemic, which we don't even have figures for because the ONS pretty much gave up at that point. And we know how the government used that as an excuse to remove the housing targets the previous administration did. You can't finish what you haven't started, of course, unless you're cooking the books. So until at least mid-2025, completions will not start looking anywhere near acceptable based on the target figures. They'll have to come up from here, and to come up they have to start, of course. Oh well, this new task force will sort it out, I'm sure. Not really, I'm sure they won't, to be honest with you, but the new administration is starting from such a low base here that the only way is up. It just isn't going to go up to 370,000 a year. And that's the macro housing picture at the moment. Fewer available rentals than any time in recent living memory. Fewer new build starts than for 15 years. Completions 20% better than most of the last decade, but still woefully inadequate. Imagine a really hostile budget or a really hostile renters' rights bill, or both. I hope those in power understand that they have millions in their hands. Will be okay, because of course we will keep calm. Carry on. So as always, your feedback is very welcome. There's a couple of questions in the live that come through that I'm going to answer just now. But please don't forget to book your early bird tickets for the 4th Property Business Workshop, Central London, Tuesday 1st of October, bit.ly/pbwfour. There's really only one way we can deal with this continual noise, and the fastest unwinding popularity rating, which I must say I find such an oxymoron for a politician anyway. We have to keep calm, always listen to the supplement. That's up. He said work again this week. As again, after the flow, you mentioned yesterday you did a couple of 2-year fixes this week as opposed to 5. Have you changed your thoughts on opting for 5 years? Brilliant question, and probably slightly out of context from me, so apologies for those who do follow closely what I'm saying and doing, because I share what I'm doing very transparently with everybody. So the reason why I did a couple of 2-year fixes this week is because they're using an automated valuation model for those valuations. So the time that this is cut out is just incredible. All the time we've got all the compliance docs, we've got what we need, we've got inspection reports, we've got all the rest of it. The time it's taking in liaising with a valuer, and our answer is largely speaking, full-time work, possibly 2 people in that, two earners in the household. It's not easy for them to value in apart from 3 weeks. And the valuer doesn't meet their service level agreement for the report around. At least another 2 weeks at the moment. That's 5-6 weeks out of the process, and we're looking at it going, well, hang on a second. We actually saw, we were lucky enough to see an internal document from one of the lenders, and it was showing they're really making an effort with these AVM to speed the process up. And we have quite fast solicitors anyway who know that we're quite demanding, but they're happy with us because we give them a huge volume of work course. So we might be able to turn. We went from one the other day to initial application to offer in, I think it was 18 hours or something like that. I mean, this is a complete game changer. The velocity of money that this is can bring to our operation is absolutely massive. Now, I have 5 year, right? This particular lender is offering 2 year. There is another lender offering 5 year, but I don't want to throw. I'm doing plenty of 5 year ones, to be clear. But I've been speaking to relationships at both lenders and trying to find out whether I'll be overwhelming them, because that's happened in the past for us with certain challenger banks where they say, hang on a second, you can't just keep applying for mortgages. Like, well, if you've got the best rate and I want it, I kind of have to. Then you have more complexity, because they then start wanting to box mortgages together. My structure is quite complex. There's a whole number of joint venture vehicles, so they can't be boxed together because they're not the same company, they're not necessarily the same business partner, etc., etc. So just trying to manage that process. But when you're on a bridge and you're looking at, well, do you know what, we'll take a 2 year now, hedge our bets a little bit, don't have a huge amount of exposure in 2026 to what's going to drop off. So we're, largely speaking, we'll be remortgaging what we see in terms of what's coming through the pipeline through late 2025 and early 2026. But the pipeline of that, I've talked about a number of times before, and there are videos on the channel talking about it. In 2027, late 27, early 28, when a lot of lower price mortgage debt drops off, we've got a big spike there. So I don't mind at the moment putting a few into 2026. But personally, I would still overall, if I was doing 1 or 2 or 3, I would advocate looking at 5 year fixes, because of the amount of admin there is involved, because of the amount of hassle there is involved. But these AVM products are an absolute game changer, and I would highly recommend anybody listening to this, if this resonates with, have a chat with Simon Das or James Rogers at 978 Finance, because they are belting these through for me at the moment, and they're doing a great job. So I'm really pleased with them. And then on to Lee's comment as well. Lee shared with us, Lee's a portfolio landlord for many years now. Great guy. He's completed on 3 sales and got 19 under offer, all due to exchange by the end of October. And that tells you exactly what Lee thinks about the market at the moment. Sure, Lee, it's evident from that comment, Lee's got a decent sized portfolio, but that's his direction of travel. What I'd be really interested in, Lee, if you're still listening, is for you to pop in the comments box, who are you selling to? Are you selling to other landlords, or are you selling to owner occupiers? Are you selling some to the tenants? I know you've got some quite nice stock there down in the southwest, so I'd be really interested to know who's buying it. And if you watch this back on replay, perhaps just leave me a comment on here, or send me a WhatsApp or whatever. So that concludes this week's Propenomix Live. Thanks, folks, for listening. I hope you enjoy it, and thanks for your comments. Thanks for tuning in. Thanks for your support. I appreciate it. Cheers. Have a good week. All the